the market's going to probably keep going up because it's been going up. Well, this is an area of distribution. You want to be thinking accumulation down here, reaccumulation, distribution, scaling out all through these areas in here, because you don't know if it's only going to come up in that little bit of that range over here in the shaded liquidity void. You don't know if it's going to fill in that and then go lower. So when you buy things down in here at a deep discount, you have to scale some of it out. But the beginning basis points of valuation in terms of the market makers, you have to look at the total range, look at where the market has moved away from quickly in those areas of liquidity voids and liquidity pools above old highs, here and here and here. That is going to be fair value for the market maker to distribute long positions. If we were looking at a sell position or a short position, we would be looking for areas in which where the market in the past has moved up a great deal with speed, and we would be looking for lows where stops would be building up below it, or liquidity pools in the form of sell stops. We would look for the lower end of the most recent range for valuation. So that way you would know by looking at things with that market efficiency paradigm, you're not looking at things like retail. You're looking at it in the scope of, okay, I am the bank. I'm making a book here. Where's the most efficient price levels for me to unload my longs or unload my short positions? We've already mentioned it so far in the teachings just for September. The easiest way to understand institutional order flow from the beginning starting point of it all is understanding that markets move from buy stops and sell stops to buy stops, and it moves from fair value to discount to premium to fair value. It moves back and forth between these three reference points. Are we at a discount? Are we at a premium? Or are we at fair value? All those things combined together, they give you the clues as to what we're seeing in terms of the market makers' action. Are they accumulating? Are they manipulating? Are they distributing? All those factors, we're going to be bringing those closely knit ideas into a more easily understood premise. When we look at price, we'll be able to see these things unfolding in advance, and you'll be able to see what should take place. And it's very encouraging to see your study in these individual components start to flesh out and have a greater understanding about price action. So in closing, fair value is not fair value in the realm of retail. It's in the realm of fair value of liquidating or accumulating from the market maker's perspective. Fair value in discount is fair value for buys, for market maker buying. Fair value in premium is fair value for market maker selling, either establishing new shorts or exiting or scaling out long positions. Discount below equilibrium in the lower ends of the range, that's a discount market. That's an area at which the market makers can buy or look to cover their short positions. Do not look at the marketplace in this retail mindset that we're all trained to do. We have the same well we drink from. It's the same regurgitated stuff, but it's wrong. To understand how these markets are delivered to us in the form of price action, when this price is delivered to us, it's not random. It's very specific of where it wants to go, why it wants to get there. That's what we're giving you in this mentorship. It's very specific.